Ladies and gentlemen, good day and welcome to the Blue Star Limited's Q2 and H1FY22 earnings conference call. We have with us today from the management, Mr. Neeraj Basoor, Group Chief Financial Officer of Blue Star Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I would now like to hand the conference over to Mr. Neeraj Basoor. Thank you, and over to you, sir.
Thank you. Thank you. Good morning, ladies and gentlemen. This is Neeraj Basoor. First of all, I hope you and your families are healthy and are safe. Today I will be providing you an overview of the results of Blue Star Limited for the quarter and half year ended September 30th, 2021. First, let me talk about the financial highlights. The quarter commenced on a strong note with extended summer in the northern parts of the country. There was healthy demand and robust volume growth for room air conditioners and refrigeration products compared to Q2 FY21, with the ebbing of the second wave of the pandemic and the consequent easing of restrictions and improvement in consumer sentiment. Commercial, manufacturing and other institutional segments also revived. Most importantly, the collections were healthy, resulting in substantial reduction in borrowings. However, escalation in commodity prices, logistics cost and INR depreciation resulted in margin pressures. Financial highlights for the quarter ended September 30, 2021 on a consolidated basis are now being summarized by me. Revenue from operations for Q2 FY22 grew 37.4% to rupees 1239.74 crore as compared to rupees 902.12 crore in Q2 FY21. EBITDA excluding other income and finance income for Q2 FY22 was rupees 70.70 crore, EBITDA margin 5.7% of revenue as compared to rupees 55.08 crore, EBITDA margin 6.1% of revenue in Q2 FY21 due to the impact of increase in the input cost coupled with the rollback of cuts in discretionary spends. Profit before tax grew 107.9% to rupees 47.44 crore in Q2 FY22 as compared to rupees 22.82 crore in Q2 FY21. Tax expense for Q2 FY22 was rupees 15.99 crore as compared to rupees 7.42 crore in Q2 FY21. Effective tax rate for Q2 FY22 was 33.9% as against 33% for Q2 FY21. Net profit for Q2 FY22 grew by 104.2% to rupees 31.45 crore as compared to rupees 15.40 crore in Q2 FY21. Carried forward order book as of September 30, 2021 grew by 5.5% to rupees 3,185.91 crore as compared to rupees 3,019.57 crore as on September 30, 2020. Capital employed reduced to rupees 938.14 crore as on September 30, 2021 as compared to rupees 1124.27 crore as on September 30, 2020 on account of continued focus on working capital efficiencies. Prudent working capital management enabled us to end the quarter with a net borrowing of rupees 44.34 crore. This is debt equity ratio of 0.05 as compared to a net borrowing of rupees 344.06 crore as of September 30, 2020, which was debt equity ratio of 0.44. I will now cover business highlights for our three business segments for Q2 FY22. First, segment 1, electromechanical projects and commercial air conditioning systems. Our segment 1 revenue grew 33.8% to rupees 723.40 crore in Q2 FY22 as compared to rupees 540.83 crore in Q2 FY21. Segment result was rupees 46.54 crore. 6.4% of revenue in Q2 FY22 as against profit of rupees 34.41 crore, 6.4% of revenue in Q2 FY21. Order inflow for the quarter grew by 3.5% to rupees 709.13 crore as compared to rupees 684.91 crore in Q2 FY21. Our electromechanicals project business. Overall pace of execution of projects and order finalizations improved as compared to the previous quarter. Order inflows from the factories and light industrial sector continued to be encouraging and are expected to offer significant opportunities in the coming months. The inflow of orders from the commercial buildings and infrastructure sectors is beginning to pick up. We will continue to focus on opportunities in the infrastructure sector such as metro railways, electrical substations and water distribution in sectors such as factories, data centers and warehousing, which are expected to throw up good opportunities in the medium term. Carried forward order book of the electromechanical projects business was rupees 2240 crore as on September 30, 2021 as compared to rupees 2070 crore as on September 30, 2020, a growth of 8.2%. Major orders received by us during the quarter were from L&W Construction, Embassy Realty and Max Square. Commercial air conditioning systems. We continue to gain traction in the healthcare, pharma, industrial and government customer segments, coupled with early signs of recovery in key segments, namely retail, IT and educational institutions, enabled a good growth for the commercial air conditioning business during the quarter. We continue to maintain our number 1 position in ducted air conditioning, second position in VRF and third in the chiller product categories. Major orders bagged in Q2 FY22 were from late Minatai Thakre COVID Hospital, NMMC, Bharatiya Reserve Bank Note Mudra Mysore, NTPC, Reliance Retail, ONGC and ISRO Sriharikota. Our international business. The faster recovery in the Middle Eastern markets enabled a strong growth in revenue during the quarter. Demand for both air conditioning and refrigeration solutions improved across SAARC and the Middle East markets. The ongoing Dubai Expo 2020 and the just concluded IPL and the ongoing T20 Cricket World Cup offer good opportunities during the quarter in the UAE. The projects business in Qatar continued to do well with a pickup in order inflows and execution of the projects. The operations at the joint venture at Malaysia continued to be impacted during the quarter due to lockdown restrictions imposed there on resurgence of COVID-19. We continue to explore new markets for business opportunities and expanded our export business to Tanzania. I will now talk about segment 2, unitary products. Segment 2 revenue grew 42.7% to rupees 454.71 crore in Q2 FY22 as compared to rupees 318.65 crore in Q2 FY21. Segment result was rupees 23.26 crore, which was 5.1% of revenue as in Q2 FY22 as compared to rupees 11.73 crore, which was 3.7% of revenue in Q2 FY21. Cooling and purification products business. Despite extended monsoon, our revenue grew 35% over Q2 FY21 in line with the market. We maintained a market share of 13%. Upgradation of residencies and the revival in the light commercial sector are driving the demand. As in the past, Tier 3, 4 and 5 markets constitute more than 60% of our revenue. Our reject product portfolio for addressing the middle of the market is helping us to compete effectively. We have further consolidated our position in the e-commerce space. Dealer network expansion in Northern India is on track. We have applied for PLI benefit for sheet metal components and heat exchangers. BLUESTAR Climatech Limited, the wholly owned subsidiary, has commenced construction of a new factory for room air conditioners at Sri City, and the same is expected to get commissioned by October 2022. Due to the unprecedented increase in the commodity prices and logistics costs, we implemented price increase of 3% effective September 1, 2021. Our commercial refrigeration business. Pickup in consumption in the commercial food segments, coupled with continued traction for the medical and supermarket refrigeration equipment, enabled a growth in revenue for the commercial refrigeration business during the quarter. Additionally, demand for storage water coolers and bottled water dispensers have also picked up due to the partial reopening of educational institutions and commercial establishments. During the quarter, we launched new variants in storage water coolers and angular glass top freezers, which offer better product visibility and merchandising. We continue to maintain our leadership position in deep freezers, storage water coolers, and modular cold rooms. The new deep freezer plant at Wada shall commence commercial production from January 2022. Major orders were backed by us from Reliance Retail, ITC Fortune Hotels, SRL Limited, Omega Systems, and Zydus Cadila. Segment 3, Professional Electronics and Industrial Systems. Our Segment 3 revenue grew by 44.5% to rupees 61.63 crore in Q2 FY22 as compared to rupees 42.64 crore in Q2 FY21. Segment result is lower at 9.83 crore, which was 16% of revenue in Q2 FY22 as compared to rupees 8.15 crore, which was 19.1% of revenue in Q2 FY21 due to product mix changes. Revenue for the quarter grew on the back of a few large value orders received in the data security solutions, non-destructive testing, and our healthcare business. The data security solutions business continued to do well, led by various digitization initiatives in the BFSI sector. The testing machines business is also witnessing growth with a revival of investments in the manufacturing sector. Major orders were backed from State Bank of India, Federal Bank, HDFC Bank, Bharat Electronics, Jio Platforms, to name a few. With a wide portfolio of products and solutions forming part of our offerings, the prospects for this business segment continue to be positive. With the business environment returning to near normalcy and the upcoming festive season, the demand for our products and services is expected to be robust. We believe that with the acceleration of the vaccination drive, the impact of the third wave, if any, shall be minimal. With the revenue reaching pre-COVID levels in the second quarter, we expect the growth momentum to continue through Q3 and Q4, leading up to the next summer season. The pricing corrections will continue depending on the input costs, and at the same time, product cost rationalization through value engineering and alternate designs, as well as operating cost reductions, will be undertaken to counter the margin pressures. With that, ladies and gentlemen, I am done with the opening remarks. I would like to now pass it back to the moderator, who will open the floor to your questions. I will try and answer as many questions as I can. To the extent I am unable to, we will get back to you via email. With that, we are now open for your questions. Thank you.
Thank you very much. Ladies and gentlemen, we will now begin the question answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Bhumika from DAM Capital. Please go ahead.
Yes, sir. Good morning, sir, and congratulations on a good set of numbers in a challenging environment. Yes, sir. So just wanted to understand on the margin profile for both EMP and cooling. Both have seen almost a near normal reversion given the lean period for cooling products, and EMP back to the historical 6.5% kind of margin profile. So just wanted to understand, with the kind of raw material increase for UCPL, is this 3% price hike that you've taken in the month of September good enough to kind of come back to our 8% kind of normalized level of margin on an annual basis as we move ahead? or will the industry need to take further price hikes? Also, if you can talk about other players, if they have also taken price hikes as well.
Yes, Bhumika, good questions. See, there are two things. Firstly, of course, there is these headwinds around raw material and other input cost increases, which everyone has been facing now for the last few quarters, and particularly the last couple of quarters. So as a consequence, of course, these price increases that we have taken ever since January of this year, we've been regularly introducing price increases across most of our business segments, have to a very large extent helped us absorb the impact of the input price cost increases. Also bear in mind, we have rolled back substantially the discretionary cost cuts which were introduced last year. So the numbers that you have seen are after pretty much, and the example I'd like to give is on the employee cost, because you remember last year we had undertaken employee cost rationalization because of the ongoing COVID issues at that point in time. Those have been rolled back.
Okay.
So the cost, the operating cost is at a normalized level. Mm-hmm. Of course the input cost we are facing headwinds, which have been to a large extent been neutralized as an account of these price increases. Now, as far as future position goes, we continue to watch the emerging trends on the input cost situation, and if needed, we will consider further price increases as may be appropriate. Of course, we have to watch the market very closely. We have to see how the situation plays out. Our understanding is most of the players have also taken and effected price increases. So this is an evolving situation, but of course, like I mentioned, we will consider further actions in the quarters that will unfold as the situation requires.
Okay. So, and would it be fair to say, that there would have been some low-cost inventory because there was inventory of the summer season which was still there with us, which would have also helped a little bit in terms of the margin profile in the current quarter?
Well, the inventory wasn't a very substantial buffer to that extent. While yes, to some extent, end of quarter one we had inventory which was a little higher than normal, but nothing compared with where we were last year, and I'm talking industry as a whole as well, and of course our own situation. And you'll remember we mentioned in the last earnings call, pretty much in quarter two the inventory, to the extent we had some extra buffer, has got fully liquidated out, and we are at normal levels already. So that advantage probably would have been there for the first month or so of the quarter, maybe first 45 days, but no longer now. So we are now having inventory which is pretty normalized, at a normalized level now.
Thank you. The next question is from the line of Ravi Swaminathan from Spark Capital. Before that, I would like to remind participants to please limit your question to 2 per participants. You may come back in the question queue if you have a follow-up. Over to you, Mrs. Swaminathan.
Hi, sir. Good morning. Thanks for taking my question. My first question is with respect to the projects business. So we had talked about good traction returning back in infrastructure projects like airport, metros, even data centers, etc. So can you quantify to us in terms of, say, either in terms of bid pipeline compared to, say, last year or say previous year, as to how that would have moved? Would it have seen a substantial increase? If you can give some clarity on that, it will be great.
Yeah, thanks, Ravi. So Ravi, I'll just read out that section again. So the order book that we carry forward, as far as the segment is concerned, I'm talking about the projects business only. We have an order book of around 2,200 crore end of September this year, and last year same time we had about 2,000 crore. Now that's one data point. The other data point is our order inflow for the quarter. Roughly we got about 700 crores of orders as compared to 680 crores last year. So pretty much we are maintaining a traction. Now bear in mind that we are still coming out, the market is still coming out of these lockdowns specifically impacting some of our customers. And therefore, what we have been mentioning to all of you is that our greater focus on light industrial sector, on infrastructure such as metro rail, electric substations, factories, data centers, warehousing, healthcare. These are the customer segments which we find the traction is reviving quite encouragingly. We are still looking at the traditional customer segments such as commercial real estate and privately funded infrastructure projects a bit carefully, because that's where the overall impact of COVID and the pandemic caused disruption probably will continue, and also equally the hospitality and some of the associated sectors. So the order book looks good. The traction is normal, I would say, in the context of the scale of disruption that we have all been through. And from here on, we think we continue to remain optimistic in terms of adding newer customers as the economy continues to revive further, which will help this particular category continue to register the good growth you have seen so far. So that's how we are looking at this segment.
Okay, but my second derivative question is, so will the orders from the infrastructure projects like metro, airport and data center, will it be enough to compensate or more than compensate for the softness in the commercial real estate space? So
yeah, to some extent, or to a very large extent, even in the past or last few quarters, we have seen that trend. So for example, I'll give you a couple of examples here. So the light industrial sector now, it is on account of this private capex on the factories, the PLI or the focus on this Make in India policy, which is kind of creating this entire urgency or requirement to invest in the manufacturing capex. So that's a good development which we can clearly see is happening. Similarly, the focus on government infrastructure continues. So whether it is privatization of airports, metro rail, those projects continue to get tendered reasonably frequently. And the expansion of the digital footprint, which has got accelerated in the last 2 years, has resulted in increased demand of data centers. And also equally, the expansion of e-commerce is causing an increase in the warehousing space as well. And all these are good customer segments for us to consider in terms of our own expansion and growth opportunities. And that's exactly what we've been focusing on.
Got it, sir. My second question is with respect to the cooling products business. Past 6 to 9 months, what would have been the absolute price increase that we would have taken? Would it be in the 10 to 12% range? And the kind of revenue run rate that we are doing currently for the full year for air coolers, air purifiers and water purifiers, and if you can talk about the profitability of these individual products to an extent, that would be great. Thanks.
So Ravi, we've taken price increases ever since January this year. Till date, you can say roughly ranges from 12 to 14%. We've taken it in installments. We haven't, over the last 3 or 4 installments we took in that unitary cooling product segment. So that covers both the room ACs as well as the commercial refrigeration products. And like I mentioned, the price increases were necessitated to partially offset the impact of the input cost headwinds. That's been taken. As far as the profitability is concerned, we talked about it in our last earnings call as well. We expect to come back to our desired profitability margin profile of 8 to 9% by the time we reach Q4. The financial year as a whole, as you can imagine, because of Q1, will continue to be impacted, but then we are not too much worried about that. We feel by the time we come to Q4, our normal margin profile in this segment will start looking better and more encouraging.
And the air cooler, air purifier, water purifier, sorry, I missed the run rate, revenue run rate at which we are going now.
So we usually tell you about the segment as a whole. We generally don't dissect the segment into various product categories.
Okay. Got it, sir. Thanks.
Thank you.
Thank you. A reminder to the participants again, if you wish to ask a question, please press star then 1. Also reminder to the participants to please limit your question to 2 per participants only. The next question is from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Hi, Neeraj. Thank you for taking my question. Just one question from my side on the kind of spend we are doing in the North market for the UCP segment and the kind of hirings and teams we are making there. Can you tell us, when you saw the improvement in the North market in your latest results, how has been the response of a consumer to our products, especially in the new ranges what we have launched? If you can throw some light how the channel is responding and stocking up your new product range, especially in the North market.
Yeah, thanks, Nitin. So yes, it's been quite encouraging, and we've been working on the northern market, you're aware, for the last couple of years now, a little over a couple of years actually. So it was a mix. It has been a mix of couple of initiatives, few initiatives. One is, of course, expansion of the channel, both expanding and deepening our presence. So that's been one initiative. The other is, of course, and that results in better engagement and deeper connect with the channel partners. And the second one, to complement this initiative, has been to offer a product portfolio which we have launched now for the last almost a year, which is targeting the belly of the market in terms of the price points as well as the quality perspective, which we are calling the mass premium range of products. A combined impact of these initiatives has been encouraging, and as we speak, are not of our overall sales, North and South are now equal at around 35% each, and then followed by, of course, West and followed by East. So that's how the pecking order is, and you'll recollect that till about a few years ago, North used to be relatively lower than South and the rest of the regions, which has now picked up. So the answer to your question is relative to the efforts by us, and I won't say as much spends are incidental. It's the overall effort that we've undertaken to supplement and grow our northern markets is beginning to show good results and is paying off, is how I will put it across.
Because I was asking this question because when we launched, in previous season, which got bad because of the COVID, we saw quite different category of products coming into North and when the COVID came. So this season, we feel that some market share movement needle can happen for us in the North market this time.
So well, our product portfolio is not crafted for any specific region. Our product portfolio is almost uniformly, offered across all the regions. So there's no product portfolio level differentiation that is needed. Well, the portfolio itself is quite comprehensive and quite vast. So it caters to the requirements of most customer segments and most customer categories in that sense. But of course, the efforts have been, like I said, a combination of expanding the channel outreach, as well as getting the product portfolio to become more attractive for a larger number of customers, which is what is helping us. And not the same phenomena is also supporting us in West as well as South.
And would you like to change any guidance on the EBIT margin of the UCP segment? I remember, correctly if I'm wrong, 6.5% was our whole year guidance there. Would you like to change given the kind of price increase has happened, or you will still wait one more quarter to look more of a stability and how the season really pans out?
Nitin, I wish I could give you some answer there, but the fact is that we are still in the middle of, or let's be more optimistic. We're still not over with the pandemic. While the worst seems to be over, the pandemic has not gone away, and the input cost headwinds are still pretty strong. So we continue to take several actions in order to manage and respond to these challenges, and that's what you see in our results. We continue with those efforts, and yes, of course, all of us are hoping for a very normal full financial year FY23, and we want to walk into FY23 by the time we exit FY22, again on a strong positive note with a greater degree of normalization, both internal as well as external as far as the environment is concerned. So I guess this is a question we'll broach in FY23.
Got it. Thank you so much, Neeraj, and all the best.
Thank you, Nitin.
Thank you. The next question is from the line of Bhavan Vitlani from SBI Mutual Fund. Please go ahead.
Thank you for the opportunity and congratulations for good set of numbers.
Thanks, Bhavan.
The first question is on the unitary cooling. So 43% growth. If you could help us break that between what could be for the room air conditioner and the commercial refs. And the reason I'm asking is a couple of quarters ago you mentioned that there could be a near-term bump up because of special refrigeration for the vaccination.
Yeah. So Bhavin, as far as the overall situation goes, in segment 2, obviously the room ACs as well as the commercial refrigeration products are doing, I would say, equally well for different reasons though. So in terms of that growth, so the growth is pretty much, you can say it is slightly better in the commercial refrigeration space because I've already talked about our growth of 35% over Q2 FY21 as far as the cooling and purification products are concerned. Now this is room ACs plus the other purification products that we sell. So to that extent, of course, the refrigeration products have done a little better than the room AC products, but then directionally, they are both demonstrating good and quite encouraging growth opportunities. As far as the commercial refrigeration products are concerned, you'll remember we mentioned that as far as the vaccination-driven demand was concerned, which started somewhere same time last year, was quite visibly a short duration opportunity which has worked well last financial year and parts of this financial year as well. But as you can imagine now that the vaccination program is maturing out quite effectively across the country, we don't think that will continue to funnel any significant opportunity going forward. So that's pretty much to the extent those infrastructure had to be created in terms of cold rooms and vaccination equipment. Whatever that part has already been that opportunity is already played out. But yes, as far as the commercial refrigeration products are concerned, we see encouraging opportunities in the supermarket space, in the medical, in the healthcare space, in the pharma space, and as the educational institutions begin to open up, as the markets are beginning to open up, of course the traditional customers for our refrigeration products will also start getting normalized. So overall, it's a very balanced situation in our UCP segment, in the unitary product segment, and to that extent, we think that directionally the opportunities will continue to be equally encouraging for both room air conditioners and commercial refrigeration products.
Oh, that's helpful. The second question is, if you could just help us on the Sri City expansion, what's going to be the phased wise capacity, because we talk about a considerable expansion in terms of our installed base. And a related question is, are we also targeting exports market, and if you could also just highlight about the efforts taken towards building the exports market.
Yeah, so Sri City expansion that has just got started. I mean, we just broke ground a few weeks ago in Sri City. Firstly, the project is expected to get commissioned by October 22. It will be a phased rollout, and we will start augmenting our room AC manufacturing capacities there to begin with, and then over a period of time we will inform everyone, what will be the installed capacities which will finally come up. But then you can consider that obviously since it's a greenfield project, we will look at significantly expanding our capacities beyond what we already have in the Himachal plants. So that's the directional sense that I wanted to provide. Yes, of course, over a period of time, once we have catered to our domestic requirements, we will also consider exporting from this plant. Though as of now, most of our exports are focused on the central air conditioning products and related solutions, but yes, there is some market for room air conditioning products as well. But of course, our priority will be first the domestic market as far as the room AC products are concerned. And this will mostly be visible in FY24, because by the time this plant goes live, it will be the fag end of FY23.
Mr. Vidlani, does that answer your question?
Yeah. Thank you so much. Yeah.
The next question is from the line of Anupam Gupta from IIFL Capital. Please go ahead.
Yeah, thanks for the opportunity. So two questions. Firstly, on the unitary product segment, if I see the capital employed there is pretty high, even let's say versus last quarter and even previous quarter. So is that firstly, what is the composition that is more raw materials, and also let's say the discussions we are seeing in trade movements globally? Is that towards that, or how do you explain that phenomenon?
Anupam, your voice is breaking. Can you please repeat your question? I heard the first part, I couldn't hear the second part clearly.
Yeah, so what I was asking is basically the capital improvement, the unitary product segment is one of the highest which you have seen, let's say, even if you compare to last year. So,
sorry, your voice continues to break, Anupam.
Is this better? Hello?
Yeah, try it one more time, please. Try one more time.
While speaking.
Yeah. So what I was asking is your capital employed in the unitary product segment is pretty high. Is this in preparation for the raw material thing, and does it cover the disruptions which you are seeing in the freight movements for the second half?
Yeah. So segment 2, capital employed, the increase you need to bear in mind is on account of a couple of factors. First and foremost, you will remember we have talked about expanding our deep freezer production capacity, and for that a new plant is getting commissioned in the next couple of months in Vada. So we have incurred capital expenditure in that for that capacity enhancement, which is getting reflected as part of our segment 2 capital employed. Of course, there is a little bit of inventory impact still that is left in segment 2, and we have indeed accelerated procurement of some inventory as compared to usually we would have started procuring somewhere in the months of November and December. This time, because of the inordinate increase in the lead times as well as disruptions that continue specifically to the imported component space is concerned, we have stocked up some components in anticipation of production requirements for Q3 and Q4. So it's a mix of these factors.
Okay.
And 3CT, of course, you heard me on 3CT. So the initial capital expenditure that is getting incurred on our 3CT project also will get rolled up as part of this segment capital employed.
Sure. Understand. And my second question is relating to the project business. So the way I see it, your commentary there is pretty optimistic in the sense you're talking about healthy traction across segments, and you've also seen recoveries in your receivables as well as your margins have trended up this quarter. So should we read it like let's say in the next couple of years the growth can pick up meaningfully and you can maintain these sort of margins here with the current working capital cycle, or is it too optimistic to read it that way?
Yeah, so Anupam, clearly there's a triangulation of three variables in that segment. In fact, in both segments, but in segment 1, it becomes a bit more profound. So a combination of the growth and the growth opportunities, coupled with what kind of margin profile we can expect to achieve for the segment, taken together with the cash flows or the overall operating cash cycle. These are three elements that triangulate the overall balance of growth and profitability for segment 1. So far we have balanced it out, I would say, notwithstanding the disruption and the uncertainties that continue to prevail. We think this learning that we have got and we've been able to execute now for the last few years is helping us. And with the reopening of the market, with reopening of so many traditional customer segments which were kind of subdued for the last 5 quarters, it should only give us a little bit of additional positive push in terms of the opportunity and the landscape, which we can then explore further. Or the order book, you heard me, looks quite healthy and encouraging, and we feel that as long as we continue to stay focused, very sharply focused on execution excellence as well as the fundamentals, managing the fundamentals efficiently, we see no reason why this segment, that's the reason for the optimistic sound bites that you hear from us.
Sure. That helps. Thanks a lot.
Thank you.
Thank you. The next question is from the line of Adesh Mehta from Motilal Oswal AMC. Please go ahead.
Hello, sir. Congratulations on good set of numbers. Just wanted to understand, how do we visualize your opportunity in data centers? Would you have some sense on, what kind of order book would we benefit per megawatt of capex in data center?
Yeah. So Adesh, we are okay. Let me talk to you about firstly the overall landscape. So two things are happening. There are two sets of factors which are playing out. First and foremost, because of regulatory reasons, the need to house and host data within India has increased substantially. You would have read about a lot of these news articles as well. So there is, on the one side, arising from data confidentiality and security concerns, a regulatory push to have, and there are several customer sectors which have a need to do this. So that's one reason why there is a good requirement that is arising. The second reason is more, I would say, connected with the way this pandemic-related resiliency has played out for a number of customer segments, which is the substantial enhancement of digitization and the digital footprint across most business processes which companies and customers have had. So a combination is that the requirement for data centers looks encouraging. And this is a very specialized, from our perspective, when we talk about a MEP project involving data centers, it involves specialized experience and knowledge, because as you can imagine, data center which will physically house the computing hardware, servers, etc., will need specialized air conditioning and electrical work. And that's where our experience and past track record or the pre-qualifications we have plays a good role. I'm not sure whether I'll be able to give you a specific number here, but the overall funnel of discussions we having or we continue to have in this space looks good. Probably by the year end, we do it once a year actually, we give some sort of a high level breakup of our order book into various customer categories in our segment 1. Probably by the year end, we will review this again and we will consider giving some sort of a breakup for this line. If it makes sense. So we will consider this towards the end of the year. But at this point in time, all I can share is it looks healthy, it looks encouraging, and our existing experience in this space is helping us.
Thank you, sir. And last question from my side. How do you see the demand environment right now, especially on the consumer side?
So the demand even in Q2 was good, I would say, because notwithstanding the unseasonal rains and the weather patterns seem to have become quite unpredictable, as we all see all around us. Despite that, and Q2 actually is the lowest selling quarter as far as the commercial refrigeration and air conditioning products are concerned. Yet we saw good demand momentum, specifically at the beginning of the quarter. Now, part of that could be because obviously quarter 1 was impacted and there could be some spillover impact, which we will not know, but then maybe we can factor that in as well. As we step into Q3, which is the festival season, we see no reason why the consumer sentiment will not be positive, because Obviously, the one is anyway. This is a good festival season, as well as the customers are witnessing more normalcy all around them, and we did experience some of this factor last year in Q3 as well. So we remain quite hopeful that if our last year's quarter three experience is anything to go by, we think the customer sentiment on the demand side should remain positive.
Thank you, sir. Wish you all the best.
Thank you.
Thank you. A reminder to the participants, if you wish to ask a question, please press star, then 1 on your touchtone telephone. The next question is from the line of Anupam Gupta from IIFL Capital. Please go ahead.
So just a couple of bookkeeping questions I had. What should be the tax rate FY22 onwards, and what will be the capex which one should assume for this year and next year?
So Anupam, next year we expect to migrate to the lower 115 BA tax rate of 22% plus surcharge, but the effective tax rate would be somewhat higher. So I would say in the range of 28 to 30% is what we are anticipating, because we'll be moving into the new tax rate regime. The normal capex of close to about 100 crores will continue, because that's something we continue to incur in our existing plants. In addition to that, the capex in our Sri City project will get formed up by Q4 for FY23. So though we have started work, we are just the design etc. getting finalized, so that probably we'll share with you in Q4.
Okay, and FY22 tax rate should be full tax rate of 33? Or
yeah, almost what you see in the H1. It will be at the same level.
Okay, fine. Thank you.
Thank you. Ladies and gentlemen, that was the last question for today. I would now like to hand the conference over to Mr. Neeraj Basood for closing comments.
Thank you very much, ladies and gentlemen. With this, we conclude this quarter's earnings call. We offer you season's greeting and wishing everyone the best of health and stay safe. Do feel free to revert to us in case any of your questions were not fully answered. We will be happy to provide you additional details by email or in person. Thank you very much and goodbye.
Thank you. On behalf of Blue Star Limited, that concludes this conference. Thank you for joining. You may now disconnect your line.